Man, have you felt it lately? That really chaotic, turbulent feeling in the markets? I mean, from tech stocks to crypto, there's just this nervous energy everywhere. And a lot of folks are starting to draw some pretty unsettling parallels to one of the most infamous moments in all of financial history. Okay, so let's dive in and really unpack what's driving all this fear.
Right, so that's the million-dollar question, isn't it? Is this just some temporary blip, or is there a much deeper, more fundamental reason for all this chaos we're seeing? Well, the analysis we're digging into today suggests it all points back to one surprisingly specific source for all this anxiety. I mean, just take a look at the last week alone. We've seen these huge sell-offs in the biggest tech stocks. Gold, silver, and Bitcoin all took a serious nosedive. There was even this very strange, coordinated short-selling attack on silver over in Shanghai. And maybe the biggest red flag? Corporate insiders have been dumping their own company's stock at a rate we haven't seen since the 2020 crisis. It's a messy picture, to say the least.
Okay, so you see all this chaos, and you'd think these events are all disconnected, right? But the analysis we're looking at today says nope. It argues that these are all just symptoms of one single, really big underlying concern. And it's not what you might think. It's not directly about AI or inflation. It's about a potential shift in the one institution that has always been the market's ultimate safety net. And that brings us to this guy right here, Kevin Warsh. He's a potential nominee for the next chair of the Federal Reserve. And here's the kicker. It's his very specific, and for a lot of people, frankly, terrifying view on how to handle a crisis that has investors completely on edge. This quote, this really gets right to the heart of the matter. Warsh has basically said, look, that first round of quantitative easing, QE1, back in 2008, that made sense. It was a logical move to stop the bleeding. But everything after that, QE2, 3, and 4, he believes those were all big mistakes. The bottom line is, he's not a fan of the Fed just endlessly printing money to solve every problem.
And this, right here, is the absolutely crucial point. It's all about a massive shift in expectations. You see, for years, investors have operated with this safety net in the back of their minds called the Fed put. It's this core belief that no matter how bad things get, the Fed will always step in with a fire hose of cash to save the markets. But a Warsh Fed? Whoa, that signals something totally different. It's like them saying, sure, we'll throw you one life raft, but it's not going to get you all the way back to shore, and it's definitely not going to push you to new highs.
All right, so you might be thinking, so what? He's against endless money printing. Big deal. But why is that specific viewpoint sending such huge shockwaves through the market at this particular moment? Well, the answer isn't just about his philosophy. It has everything to do with the current state of the market itself. See, the big fear here is that someone like Warsh could be taking the helm at the exact moment when the market is, well, looking incredibly overvalued and fragile by a bunch of historical measures. Let's actually dig into the data that this analysis highlights. Okay, check this out. This is called the Buffett indicator, and it's pretty simple, really. It just compares the total value of the stock market to the country's GDP, the size of the whole economy. Now look at these numbers. Right before the 1929 crash, it peaked around 130%. At the very top of the dot-com bubble in 2000, about 150%. And today, we are sitting at a mind-boggling 230%. That's an all-time high by a long shot.
And it's not just one indicator telling this story. Here's another one, the Shiller P/E ratio, which measures stock prices against their long-term earnings. Today, we're at a level of 40. Now, to put that in perspective, that's way higher than the 1929 peak, and we're getting awfully close to the dot-com bubble, which was the highest it has ever been. The worry is that the market is priced for absolute perfection, with zero room for anything to go wrong.
And that's why everyone keeps bringing up 1929. See, it's not just about the high valuations. It's about what happens to a super expensive market when that safety net is suddenly pulled away, when the authorities either can't or, more importantly, won't step in to stop the fall. 1929 is the ultimate nightmare scenario of a crash without that modern Fed put. And when you look at the timeline from back then, wow, it is just brutal. The market peaked in 1929, right? It took three full years just to find the bottom in 1932. And then, here's the real gut punch. How long did it take to get back to where it started? 26 years. An entire generation went by before those initial losses were even recovered. That is the kind of prolonged pain investors fear when the safety net is gone. Of course, the common argument you hear today is, but wait, we have the AI revolution. That changes everything. Well, what's fascinating is that the source analysis points out the 1920s had its own incredible technology boom. Think about it. The widespread adoption of cars, planes, and tractors led to huge productivity gains. But that amazing tech boom, it did not prevent the market from collapsing.
So what finally did turn things around back then? Well, according to this analysis, it was, you guessed it, a massive monetary intervention. In 1934, after collecting gold from its citizens, the U.S. government dramatically revalued it, basically overnight. This move instantly created a tidal wave of new money in the system, acting as the massive QE of its day, and it's what finally broke that terrible deflationary spiral. And that brings us right back to the core fear today. The worry is that without that kind of overwhelming response, the market could be facing a downturn lasting, 2 to 3 years, just like that 1929 to 1932 period. According to this analysis, this is the exact scenario that a QE one and done policy might create.
Now, let's be super clear here. None of this is a certainty. This isn't a prediction. It's an explanation of a major risk that is clearly worrying the market. So, with that in mind, what are the key things we need to be watching for in the coming weeks and months?
Okay, so first, all eyes are going to be on Warsh's Senate confirmation hearings if he's nominated. What will he say when he's questioned directly about these policies? Second, we've got to listen for any public statements he makes that might show if his views have changed at all. And third, remember, it's not just about him. It's about how many other members of the Fed's policy committee might actually share his less interventionist views.
And I really have to underline this again. We are not making a prediction here. We're objectively explaining a line of thinking that is causing some very serious concern among investors, and it's helping to drive the volatility that we are all witnessing. This is all about understanding the why behind the market's fear right now.
So that leaves us with a final critical question. We can see the warning signs in the valuation metrics, and we understand the potential for this huge shift in policy. The real question now is, just how much of this historical risk is already being priced into the market today?